Assalamu alaikum viewers. We are in the fourth lectures of accounting cycles. This is the English version videos. In the first lectures, we discussed that the accounting consists of two important books. One is the journal and other is the ledger. Ledger consists of many ledger accounts. In the second lectures, we discussed the definition of accounting, that is recording, classifying, summarizing and reporting. Also, we discussed the basic financial statement. In the third lecture, we learned the rule of debit and credit. In a fourth lecture, we present an example and try to understand the accounting cycle with a common example. I am Dr. Safdar Husain Tahir, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. I did postdoc from UWA Business School, the University of Western Australia. Look at the common example of this lectures. That is, you supposed to be an accountant of bright future traders. A trading business that deals in home appliance. The business was started by Mr. Usman on December 1st, 2024 with an initial capital invested of Pak rupees 2 million deposited into a business bank account. These are the transactions of December 1, December 2, December 3, December 4, 5, 6, 7, 8, 9, 10. These transactions, we are going to debit and credit of these transactions in a general journal. This is the second phase, and later on we incorporate this phase to this accounting cycle. The accounting cycle, the first phase is journalization of transactions. Only asset, purchase, liabilities and owner equity. These are the first 10 different transactions. And the first transaction, before the first transaction, you can say that the accounting equation show no asset, no liabilities and no owner equity. It means assets are zero liabilities and with zero owner equity. In the first transactions, when you invested 20 lakh rupees, 2 millions in a business, it means the assets increase 2 millions, but these assets increase by the owner equity. You can write the transaction in this way. This is the way to write the transaction, that the cash 2 million increased, 20 lakh increase, and they are the cash. When the cash increase, cash is debited. And when the owner equity increase is credited. So the debit and credit, you can record the first transaction in this way. Cash increase, that is debited. Owner capital, which is increased, that is also credited. In the second transaction, you purchase the office equipment of 1,50,000. So office equipment which was zero before this transaction, now increase 1,50,000, that are debited. And cash you paid, which is also an asset, which is credited. So 1,50,000 office equipment debited and cash is credited. In the third the transactions, you purchased a delivery van of 7 lakh. The delivery van before this transaction is zero. Now the delivery van, as the account of the delivery van increased 7 lakh. 4 lakh cash down and 3 lakh account payable, because you paid the cash of 4 lakh and 3 lakh there is account payable. So the increase in the liability is also credited. Decrease in the cash is also credited. So 7 lakh debited and equal amount 4 lakh from the cash and 3 lakh from the account payable, they are credited. And the fourth transaction, you purchase a furniture of 1 lakh, which was zero before this transaction, now increased by 1 lakh. Account payable increased by 1 lakh. Similarly, in the fifth transaction, you took a loan from a bank. The cash increased, whatsoever the amount is, increased 5 lakh, that are debited. And the note payable, this is the liability, and that also increased, that is the 5 lakh, but credited. So these are the 5 transactions we discussed in the first phase. And the next 5 transactions we will discuss in the next lecture. Thank you so much.